Imagine working a 9-to-5 job, getting a solid income, but paying $0 in taxes. Sounds crazy, right? But that's exactly what thousands of people are doing by investing in short-term rentals and taking advantage of a tax loophole that's buried deep in the IRS tax code. And the crazy part is the government is rewarding people for doing it. I'm Terrell Higgins, your real estate and personal finance guide. And in today's video, I'm gonna be breaking down how people use short-term rentals, depreciation, cost segregation studies, and a little-known tax loophole to zero out their taxes, including their taxes from their 9-to-5 job. And this is not the type of information that your CPA is just going to volunteer to you. So lean in and let's get into it. So let's start with the obvious. I am not a CPA, and this is not tax advice, but I do work with professionals that use this strategy. And I do pay my fair share of taxes, but not any more than I legally have to, and neither should you. Now let's talk about the 4 ways that real estate can make you wealthy. So the first one is the one that most people focus on. It's cash flow. And this is the money you have left over every month after you account for your mortgage, your taxes, insurance, any maintenance costs, any vacancies, and any other miscellaneous expenses on the property. That's going to be your cash flow. And then the second one is appreciation. So this is the value of the property naturally going up over time, or you can force appreciation by adding additional square footage to a property or rehabbing or renovating the property to force it to go up in value. The third one is amortization. So that's just a fancy word for debt paydown. So this is the fact that people are paying down your mortgage for you. And that's actually putting money in your pocket each month. And the last one is depreciation. And that is the magic trick. That is going to be the focus of today's video. But essentially, you can actually deduct part of the value of your home every single year until the full purchase price of the home is deducted from your taxes. So let me give you a quick example of how powerful a wealth building tool real estate can actually be. So imagine you put 20% down on a $300,000 house. That's $60,000. And then each month you're cash flowing about $500 a month. So that's $6,000 a year. That's a 10% return right off the top. And then if that home in that first year actually appreciates 3%, which is the historical average that homes appreciate at, you're going to make about $9,000 in that first year from appreciation. So with that $6,000 in cash flow and that $9,000 in appreciation, that's $15,000. That's a 25% return on your $60,000 investment on the home. That way outpaces what you can historically get from the stock market.
Pretty good.
Now let's think about that amortization piece. Imagine you bought a $500,000 home, and for 25 to 30 years, you just broke even. But then someone handed you the keys to a fully paid off $500,000 home. Would you sign up for that? I know I would. But the final wealth builder, and it's probably the most misunderstood, and it's the last thing people consider, are the tax benefits. Using that depreciation to actually supercharge your wealth. Here's how depreciation works. So if you operate a business, the IRS lets you deduct certain supplies and equipment. So if I need a stapler, a $12 stapler, the IRS lets me write that off from my taxes. But if I buy a $500,000 property, the IRS will not let me deduct all of that at once. We have to depreciate it over time. So if it's a residential property, that's 27 and a half years. And if it's a commercial property, that's 39 years. But here's the key. You can depreciate the building, but you cannot depreciate the land. So if you have a $500,000 property and $50,000 of that value is the land, you cannot depreciate that. But the remaining $450,000, you can depreciate. So that $450,000 divided by 27 and a half, which is $16,363. Every year you can deduct from your taxes. So if that property was cash flowing $1,000 a month, that's $12,000 a year. That completely wipes out the income from the property and you end up paying $0 in taxes. That's $16,363. That is what's called a paper loss. Because in real life, your property value is probably going up, but in the eyes of the IRS, it's going down in value. And that is what creates the deduction. But normally, you cannot use depreciation from your real estate and apply it against your 9-to-5 job income. Real estate's considered a passive income source, where your 9-to-5 job is considered an active income source. And the only way you would be able to apply real estate losses to your active income is if you're a real estate professional. And this is where the short-term rental loophole comes in. Short-term rentals like Airbnb and VRBO are not treated the same as long-term rentals in the IRS tax code. So if the average length of stay in your property is less than 7 days and you have an active role in managing the property, so that means you manage the bookings, the communications, the cleaning, all of that, then the IRS no longer views this activity as passive, which means that those losses from depreciation can actually be applied to your active income. So this is your 9-to-5 job, this is your business income, any active income source. This is the loophole. This is the short-term rental loophole. And once you understand how this loophole works, you're not going to look at rentals the same way ever again. They're not just a source of money, but they're a tool that you can use to completely slash your tax bill. Okay, let's supercharge this strategy. Remember how we took the depreciation over 27 and a half years? What if there was a way where we could accelerate that depreciation and take more of those tax benefits up front? That's exactly what a cost segregation study allows you to do. So instead of treating the property like a single asset, it breaks up the property into its component parts. HVAC system, flooring, windows, water heater, furniture, even landscaping. And all those different components depreciate over different timelines, maybe 5 years, 7 years, 15 years. And then you can move a lot of that depreciation up and front load your tax benefit. Let me give you an example. So if you had that $500,000 property and you did straight line depreciation on that home, it's about $18,000 that you can depreciate each year. But if you do a cost segregation study on that home, in that first year, you could go from $18,000 in depreciation to about $40,000 in depreciation. And if we have bonus depreciation in effect, like we did a few years ago under Trump's tax cuts and like is being proposed in Trump's tax plan for this year, you could potentially take $80,000 of depreciation in the first year. That's $80,000 in paper losses that you can apply against your W-2 income. But, and this is a big but, you have to materially participate in that short-term rental. So how do you qualify? There are two paths here. So path one is being a real estate professional. And this is the harder path. And to qualify, you need to spend 50% of your working hours on real estate activities and at least 750 hours a year doing real estate activities. And you have to materially participate in each property unless you group them all together. And this is doable if you're self-managing a portfolio. But if you have a full-time job in a different field, then you will not qualify, and this does not work. Path two is the short-term rental loophole. And this is way easier than being a full-blown real estate professional. If your average guest stay is 7 days or less, and you materially participate, meaning you spend at least 100 hours a year, and you do more work in the business than anyone else, boom, you're qualified. No license, no 750 hours. All you have to do is manage those communications, those bookings, those cleanings, and you unlock this massive tax benefit. So let's be clear about this. This isn't some sort of shady tax trick. It is written into the tax code because the government wants to incentivize investment, entrepreneurship, and housing supply. But there are a couple pitfalls to using this loophole. The first one is that you need to take time logs of all the time you spend in the business. Because if you get audited by the IRS, they're going to be requesting proof that you spent at least that 100 hours in your business. The second one is that the hours that your spouse spends in the business does not count toward your 100 hours in the business. Unless, of course, your spouse is the one who's actually trying to qualify for this short-term rental loophole. The third one is that W-2 time cannot be counted toward your 100 hours unless that real estate business, you own 5% of it. And the last one, and this is a big one, don't even consider doing this unless you have an awesome CPA in your corner. But if you do it right, you could buy 1 or 2 short-term rental properties and completely zero out your income from your W-2 job. I threw a lot of information at you today, and if you want a summary of everything we discussed here today, I actually created a summary PDF for this video, and you can download it in the description down below. If you got some value out of my video today, smash that like button and subscribe to the channel because I give no nonsense, practical financial tips like this every single week. Keep getting 1% better every day, and I'll catch you in the next video.